Hi there. Welcome to this tutorial on how to perform an analysis on a stock to help you decide whether it's a good investment. Investing in stocks can be a great way to build wealth over time, but it's important to make informed decisions based on solid research and analysis. In this video, we'll go over the key steps you need to take when analyzing a stock to determine whether it's worth investing in. The first step in analyzing a stock is to look at its price history. This will give you an idea of how the stock has performed over time and whether it's been volatile or stable. Pay attention to any significant events that might have affected the stock price, such as earnings reports or news about the company or industry. You can easily find historical stock prices on financial websites like Yahoo Finance or Google Finance. Look for trends over time and consider how the stock has performed relative to the broader market or its peers. The second step is to examine the company's financial statements, which will provide you with a lot of useful information about the company's financial health. The key financial statements to look at are the income statement, balance sheet, and cash flow statement. When looking at the income statement, pay attention to metrics like revenue, net income, and earnings per share. Look for trends in revenue growth over time and consider whether the company is profitable. It's also important to examine the company's margins, such as its gross profit margin and operating profit margin, to get a sense of how efficient the company is at generating profits. The balance sheet is also an important financial statement to examine. Pay attention to the company's assets, liabilities, and equity. Look for trends in the company's debt levels and consider whether it has enough cash on hand to cover its short-term liabilities. Finally, when examining the cash flow statement, pay attention to the company's operating cash flow, investing cash flow, and financing cash flow. Look for trends in the company's cash flow over time and consider whether the company is generating enough cash to fund its operations and invest in future growth. The third step is to research the company and the industry it operates in. You want to look for news articles, analyst reports, and industry reports to get a sense of the company's competitive position and growth prospects. Look for information about the company's products and services, its target market, and its management team. Consider the competitive landscape in which the company operates and identify its major competitors. Look at how the company differentiates itself from its competitors and whether it has a sustainable competitive advantage. Finally, consider the industry trends and growth prospects. Look at the size of the market and consider whether the company is well positioned to take advantage of growth opportunities in the future. The fourth step is to perform a valuation analysis, which will help you determine whether the stock is overvalued or undervalued. There are several methods for valuing a stock, including the discounted cash flow method, the price-to-earnings ratio, and the price-to-book ratio. When using the discounted cash flow method, you'll need to estimate the company's future cash flows and discount them back to their present value using a discount rate. Look at the expected growth rate of the company and consider any risks or uncertainties that could affect its future cash flows. When using the price-to-earnings ratio, you'll need to compare the stock's price to its earnings per share. Look at the company's historical earnings growth and compare it to its peers and the broader market. When using the price-to-book ratio, you'll need to compare the stock's price to its book value per share. This will give you a sense of whether the stock is overvalued or undervalued relative to the company's assets. The final step in analyzing a stock is to make a decision based on your analysis. Consider all the information you've gathered and weigh the risks and potential rewards of investing in the stock. If you believe the stock is undervalued based on your analysis, it may be a good investment opportunity. On the other hand, if you believe the stock is overvalued or there are too many risks associated with the company or industry, it may be best to stay away. Remember that investing in stocks comes with risks, and you should always do your own research and consult with a financial advisor before making any investment decisions. That's it for this tutorial on how to perform an analysis on a stock. By following these steps, you can make informed decisions about which stocks to invest in and which to avoid. Thanks for watching, and happy investing!